It's 3:17 a.m. in London, October 14th, 2025. A senior risk officer at one of the big bullion banks stares at a Bloomberg terminal that just flipped bright red. The LBMA silver fix is ticking $75.42. His phone explodes with margin call alerts. 4,000 miles away, in a dimly lit control room outside Guangzhou, a solar glass manufacturer hits the emergency stop button on 3 coating lines. They just received notice that their allocated silver powder will be cut 40% next month. In Washington, a Treasury staffer quietly forwards an eyes-only memo to the Fed. COMEX registered silver inventories have fallen below 65 million ounces for the first time since the Hunt squeeze. And in Zurich, the vault manager for the largest silver ETF watches the last good delivery bar leave on an armored truck bound for a private Asian buyer who paid a 28% premium in cash. This isn't happening tomorrow. This is happening right now. And almost nobody outside a tiny circle of bankers, refiners, and industrial buyers has any idea that $75 an ounce is the line in the sand where the entire paper-silver pyramid begins to detonate. In the next 12 minutes, I'm going to show you exactly why $75 is not just another round number. It is the point where the 100-to-1 leverage in the silver futures market collides with the brutal reality of physical shortages. I'm going to walk you through the same 3-phase resource lockdown pattern we've seen in oil, rare earths, palladium, and semiconductors. Only this time it ainsley is happening to the metal that quietly underpins both the green energy revolution and the banking system's biggest off-balance sheet secret. You'll see the data. The Silver Institute doesn't want to highlight the contracts the solar giants are locking in for the next decade, and the one metric that has flashed red before every major commodity blow off in the last 50 years. Let's start with the pattern. Every major commodity crisis follows the exact same 3-phase playbook. Phase 1, silent accumulation. Governments and megacap industrials quietly secure physical supply while the paper market still looks asleep. We saw it when China cornered 80% of rare earth refining capacity between 2005 and 2010, while the price barely moved. We saw it when Russian palladium vanished into state vaults in the late 90s, while Ford and GM were still laughing at $200 an ounce. Phase 2, export controls and fragmentation. The dominant producer starts restricting outflows. Prices finally wake up, but the paper market still treats it as speculative froth. Japan did it with semiconductors in the 80s. Saudi Arabia did it with oil in 1973. Phase 3, commercial signal failure and forced short. Covering registered inventories dropped below the minimum needed to support open commercial shorts. The price no longer reflects supply and demand, it reflects survival. This is the phase where a 300% move can happen in 3 months and still not clear the shortage. Silver is now deep into Phase 2 and flirting with the edge of Phase 3. Here's the data nobody is screaming about yet. Global mined silver supply has been essentially flat for 8 straight years, around 820 to 850 million ounces annually. Meanwhile, industrial demand has exploded from 450 million ounces in 2015 to an estimated 700 million ounces in 2025. That's a structural deficit of 150, 200 million ounces every single year. Where did it come from? Above ground stocks. The world has been eating its silverware. According to the Silver Institute's own 2024 report, total identifiable silver bullion inventories, everything in LBMA vaults, COMEX warehouses, Shanghai Futures Exchange, and the major ETFs, have fallen from roughly 3.2 billion ounces in 2008 to under 1.4 billion ounces today. That's a 57% drawdown in 16 years, while annual deficits doubled. Now watch this number. COMEX registered silver, the bars that actually back delivery, stood at just 64.8 million ounces as of last week. That is less than 3 weeks of global industrial consumption. For context, in January 2020, it was 180 million ounces. We have burned through 2/3 of the deliverable stock in 5 years. But the real landmine is the leverage. Open interest on COMEX silver futures is still hovering near 150,000 contracts, roughly 750 million ounces. That means for every single physical ounce sitting in registered vaults, there are 11.5 paper ounces claiming it. At $75, the notional value of those shorts exceeds $56 billion. A 10% move up triggers variation margin calls of $5.6 billion overnight. Most bullion banks fund those positions at 1 to 2% initial margin. Do the math. A move from $75 to $120 in a week is not a bullish forecast. It's a potential liquidity event that wipes out trading desks. This is where the solar boom becomes the detonator. Solar manufacturers use about 150 million ounces of silver per year right now, and the International Energy Agency projects that number hits 400 million ounces by 2030 under net zero scenarios. Every gigawatt of new solar capacity eats roughly 15 tons of silver that can never economically be recycled. That's locked away forever in microcrystalline form on glass. And here's the part nobody's talking about. The big three Chinese solar giants, Tongwei, Longi, and Jinko, have already signed 10-year physical offtake agreements at fixed premiums with refiners in Peru, Mexico, and Kazakhstan. They are not buying on the spot market anymore. They are pulling metal out of the Western system before you even wake up to the headlines. When South Korea's largest panel maker announced last month they were building their own 5,000-ton strategic silver stockpile, the market shrugged. That's 160 million ounces, more than double what's left in COMEX registered. These are not speculators. These are the commercials telling you they no longer trust the paper price. So let's talk about the squeeze mechanics. There are only 4 ways this deficit closes. Mine supply surges. It can't. Permitting N grades make that a 10-15 year fantasy. Recycling ramps up. It already runs at 98% efficiency for industrial scrap. Thrifting and substitution. Engineers have been trying to cut silver out of solar paste for a decade. They've reduced it 60% per watt and still can't get below 8 milligrams without killing efficiency. Demand destruction through astronomical prices. History says number 4 is what actually happens. 1973, oil, price went up 400% before demand finally cracked. 2010, rare earths. Prices went up 2,000% in 6 months before Japan capitulated and paid China whatever they asked. 2001, palladium. From $200 to $100 in 9 months, while Ford wrote a $1 billion check to secure Russian metal. The skeptic will say, I'll just throttle solar build-out if silver gets too expensive. Except every major economy has legally binding 2030 renewable targets, backed by hundreds of billions in subsidies. You don't hit 60% renewables by telling voters the panels got too expensive. The skeptic will say, the banks will just cash settle or change the rules like they did with Hunt Brothers. They tried that with nickel on the LME in 2022 and destroyed their own credibility overnight. COMEX delivery failures in silver would migrate trading to London and Shanghai within weeks, and the LBMA is already down to 220 million ounces total vaulted, half of it leased or encumbered. The skeptic will say, there's still 1 billion ounces in coins and bars. Yes, and 90% of it is in retail hands that learned their lesson in 2020 when they paid 50 spot while dealers charged 85 delivered. Try buying that metal back at $90 when the price is $200. Good luck. So what could this actually look like? If the current deficit trajectory holds and solar demand grows at even 70% of the IEA baseline, we are looking at 400 million ounce annual shortfalls by 2028-2029. That's the equivalent of wiping out all Peruvian production every year with no replacement. In a phase 3 breakout with no overhead supply, moves from current levels to $150 to $250 in 12-18 months are not unreasonable when you compare the inventory to flow ratio to palladium 2000 or cobalt 2018. This isn't a bubble. It's the market finally reconciling a decade of price suppression with physical reality. What does this mean for you? It means understanding that counterparty risk is no longer theoretical. A paper claim on silver at a bank or ETF is only as good as the balance sheet behind it when delivery demands spike. It means recognizing that diversification isn't just across asset classes, it's across forms of ownership. And it means paying attention when the same entities that laughed at you for owning metal 5 years ago are now quietly accumulating it behind closed doors. Study the patterns. Verify the inventory numbers yourself. COMEX, LBMA, and Shanghai reports are public. Watch the solar offtakes. Watch the Korean and Indian import premiums. Watch the registered to open interest ratio like a heart monitor. Because when that ratio drops below 1 to 10, the $75 detonation point will feel like the good old days. This video is for education and entertainment only. It is not personal financial advice. I'm not your financial advisor. Markets are volatile, prices can go down as well as up, and you can lose money. Always do your own research and make your own decisions. If this pattern breakdown opened your eyes, smash that like button, hit subscribe, and turn on notifications, because the next phase doesn't send a warning. Drop your thoughts in the comments. Where do you think the real breaking point sits? And if you found this valuable, share it with someone who still thinks silver is just an industrial metal.